Good morning, our respected lecturer and fellow my classmates. Today, we are honored to present on the topic of LKS2 inventories. In this discussion, according to LKS2, we are mainly discuss about the objectives, scope, definition, and measurement of inventories. Under measurement of inventories, we are going to discuss about the cost of inventories, cost formulas, and net realizable value. Then we discuss recognition of inventories as an expense and disclosure for transparent reporting. Today I am excited to delve into the inventories and its integral role in businesses, particularly focusing on the LKS2 accounting standard. Let's start with the basics. What is inventory? Inventory refers to the stock of goods and materials that a business holds for the purpose of resales or production. For instance, it includes the raw materials, work in progress, and finished goods that a company has on hand at any given points in time. Raw materials are the basic materials and components that are used in the manufacturing process of a product. If we take bakery as example, flour, sugar, eggs, and butter would be considered as raw materials. Work in progress refers to products that are in process of being manufactured or assembled but are not yet completed. If we take previous example of bakery, if cookies in this baking stage would be considered work in progress until they are fully baked and ready for the next stage. Finished goods are completed products that are ready for sale or distribution to customers. Based on previous examples, once the cookies are baked, packaged, and ready for customers to purchase, they become finished goods. Let's discuss what is LKS2 standards. LKS2 is part of the Sri Lanka Financial Reporting Standards, which are issued by the Institute of Chartered Accounts of Sri Lanka and are applicable to entities reporting under Sri Lanka Financial Reporting Standards. LKS2 provides guidance on the accounting guidance for inventories, including the determination of the cost of inventories and the recognition of inventories related expenses. LKS2 standard is applicable for annual period starting on or after January 1st, 2013.
Now I am going to discuss about objectives of LKS2. When it comes to LKS2, the main objectives of LKS2 is to provide guidance on how to account for inventories in financial statement. Basically, LKS2 provide accounting treatments for inventories. Accounting treatments for inventories is the established procedures and principles for recording, measuring, and reporting inventories in financial statement. Guidance on determination of cost and its subsequent recognized as an expense, including any write down to net realizable value. It involves specifying how the cost of inventories should be calculated and recognized as an asset until corresponding revenue are realized. Accordingly, it addresses situations where inventories need to be written down to their net realizable value. Guidance on cost formulas used to assign cost to inventories. This pertains to providing instructions on the method and formulas to be employed in allocating cost of different type of inventories, ensuring consistency and accuracy in financial reporting. Scope of LKS2 standard. This standard applies to all inventories except work in progress under construction contract, financial instrument, and biological assets related to agricultural activity and produce at the point of harvest. This standard does not apply to measurement inventories held by producer of certain good and commodity broker traders. Producer of agricultural products after harvest and mineral may measure inventories at net realizable value as per industry practices, and also Commodity broker traders may measure inventories at fair value less cost to sell. Net realizable value measurement. Certain inventories like agricultural crops or mineral are measured at net realizable value when specific production stage are reached. This includes situations where sales in assure under contract guarantees or in an active market with negligible risk of failures to sell. Fair value measurement for broker traders. Traders measuring inventories at fair value less cost to sell exclude only the measurement requirement of LKS to changes in fair value less cost to sell are recognized in profit or loss. In summary, LKS to outline the accounting treatment for inventories, the specific exclusion for certain type of inventories and alternative measurement methods for a producer of agricultural product and commodity broker traders. When it comes to the definition of inventory, according to the LKS2, inventories are assessed, and also in this part we talk about few key terms as well. Those are things that are held for sales in the ordinary course of business, which we called as raw materials. Things which are in the production process for the purpose of sales, which we called as work in progress. Things that are in the form of materials or supplies to be consumed in the production process or in the rendering of services, which we called as finished good. What is net realizable value? Net realizable value is the estimate selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. What is the fair value? Fair value is the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction.
Cost of inventories. When it comes to cost of inventories, the cost of inventories consists cost of purchase, cost of conversion, and other costs which are incurred in bringing the inventories to organization present location. What is cost of purchase? The cost of purchase include all costs directly related to the acquisition of raw materials, goods or service for resale. Cost of purchase include invoice price, import duties, non-refundable taxes, and handling cost. Invoice price is the actual cost of purchasing goods or service for resale. Import duty is additional cost imposed when importing the goods for resale. Non-refundable taxes are the taxes that are directly attributable to good or service when make purchases. These taxes cannot be refunded. Handling costs are the costs associated with preparing and transferring the inventory. Trade discount and rebates should reduce from the invoice price. And also, abnormal wastage cost and administrative overheads are unrelated to production cost. So we cannot consider those costs as cost of purchase. What is cost of conversion? The cost of conversion comprise costs that are incurred in transforming raw material into finished goods. Example for cost of conversion are direct labor cost, fixed manufacturing overhead cost, and variable manufacturing overhead cost. Direct labor cost are expenses directly associated with unit of production such as wages for manufacturing. Fixed manufacturing overhead cost include constant indirect production expenses like depreciation, maintenance, and administration expenses. Variable manufacturing overhead costs are those indirect costs that fluctuate with production volume like indirect material and labor cost. All other unallocated overheads for the inventory are recognized as expense of organization other operation. According to the LKS2 standard, the gains of joint product cost are allocated between the product on rational and consistent basis. What is other inventory cost? Other inventory cost include all expenses directly attributable to bringing the inventories to their present condition and the location. For example, cost of designing Product for specific customers can be included in the cost of inventories. And according to the LKS 23, borrowing cost identify as cost of inventory in limited circumstances. Let's discuss what are the costs that exclude from the cost of inventories according to the LKS 2. Abnormal amount of wasted materials, labor or other production cost. It's mean that waste in the production process does not consider as an inventory cost. Storage cost. General storage expenses that are not directly related to the production process does not consider as a inventory cost. Administrative overheads. Administrative overheads that are not contributing to bringing the inventories to their present condition and the location not considered as a inventory cost. Selling cost. Expenses incurred in promoting and selling the inventories such as marketing and distribution expenses do not consider as an inventory cost.
Let's discuss cost of inventories for service provider. The cost of inventories for service provider as per LKS2 is determined by the production cost including labor and other expense of personnel directly involved in service provision, and this incorporates supervisory personnel and relevant overheads. However, costs related to sale and general administrative personnel are not included. Instead, they are recognized as expense when incurred. It's important to note that the cost of inventories for service provider exclude profit margin and unattributable overhead typically included in service prices. Cost of agricultural produce harvested from biological asset. In agricultural produce, harvested agricultural product from an entity's biological asset is valued at the point of harvested at fair market value minus selling expense. This measurement is cost using LKS2 inventories as of that date. Now I am going to talk about technique for the measurement of cost. There are two types of technique for the measurement of cost. They are standard cost method and retail method. Standard cost method involve considering normal level of materials, labor, efficiency and capacity utilization. These costs are regularly reviewed and adjusted based on current condition. As an example, if making a chocolate cake is expected to cost $10 for ingredients and labor, you keep an eye on actual costs. If it turns out to be $12 due to high ingredients price, you might adjust your standard cost for future planning. The retail method is used for inventories with many rapidly changing items. It determines inventory cost by reducing the sale value by the appropriate percentage gross margin, considering factors like markdown item and average percentage for each retail department is often applied. As an example, you have a shirt initially priced at $50, but you put it on a sale for $30. Using the retail method, you evaluate your inventories based on $30 sale price considering the reduced margin.
Now I am going to explain about the cost formulas regarding LKS2. According to LKS2 standard, the cost of inventories for items that are not ordinary intangible and those specifically designated for distinct project is assigned through the method of specific identification. This involves attributing specific cost to individual items, making it the appropriate treatment for project segregate items regardless of their origin. However, when dealing with multitude of intangible inventory items, specific identification of cost becomes impractical. In such cases, the first in first out or weighted average cost formula are used. An entity is required to use the same cost formula for inventories with a similar nature and use. Through variation may be justified for inventories with differing nature and it use. Under the FIFO formula, the assumption is that the items purchased or produced first are sold first, leaving the most recently acquired items in inventory at the end of the period. On the other hand, the weighted average cost formula determines the cost of each item based on the weighted average of similar item cost at the beginning of the period and those acquired during the period. Let's discuss net realizable value of inventories. Assessment of recoverability. The recoverability of inventories cost depends on various factors including damage, obsolescence, and decline in selling prices. If estimated cost of completion or cost to make a sale increase, the recoverability of inventories cost may be at a risk. Also, writing down inventories at the low of net realizable value is consistent with the principle of not carrying assets at a value greater than the expected proceed from sale or use. Write down procedure. To align with prudent financial practices, the write down of inventories below cost to their net realizable value is essential. This approach reflects the principle that assets should not be carried more than amounts expected to be realized from their sale or use. Generally, inventories are individually written down to their net realizable value, but under specific circumstances, grouping similar or related items may be appropriate, such as those within the same product line. Estimates of net realizable value. The estimate of net realizable value consider the most reliable evidence available at the time and factoring in fluctuation in price or cost related to events occurring after the period end. This includes considering the purpose for which the inventory is held, such as satisfying firm sales or service contracts. Materials and supplies. The materials and supplies held for production are not written down below cost if the finished products are expected to be sold at or above cost. However, a declined material price may prompt a write down to net realizable value. The replacement of cost of materials can serve as a measure of their net realizable value in each such cases. Reassessment of net realizable value. A reassessment of net realizable value occurs in each subsequent period. When circumstances that led to write down below cost no longer exist or when there is a clear evidence of an increase in net realizable value due to change in economic conditions, a reversal of write down may take place. This ensures that the carrying amount is the lower of cost and revised net realizable value. Let's discuss the recognition of inventories as expenses according to LKS2. When inventories are sold, their carrying amount is recognized as an expense in the period when the related revenue is recognized. Write down of inventories to net realizable value and losses are recognized as expense in the period of they occur. Reversal of inventories write down due to an increase in net realizable value are recognized as an reduction in the number of inventories recognized as an expense in the period of reversal. Some inventories may be allocated to other asset account, such as inventory used in self-constructed property, plant, or equipment. Inventories allocated to other assets are recognized as an expense over the useful life of the assets.
According to the LKS2, the financial statement shall disclose following points: the accounting policies including cost formula used, the total carrying amount of inventories and classifications, the carrying amount of inventories carried at fair value less cost of sale, the amount of inventories recognized as an expense, the amount of any write down of inventories recognized as an expense, the amount of any reversal of any write down that is recognized as a reduction in the amount of inventories recognized as expense, the circumstance that led to the reversal of a write down of inventories, and the carrying amount of inventories pledged as security of liabilities. In financial statement, the disclosure of inventories involved in few aspects when disclosing. Those are carrying amount and changes in inventories. This provide valuable information on inventories, carrying amount and changes, common classification including merchandise, production supplies, work in progress and finished goods, expense recognitions. The cost of sale recognize expense for the sold inventories, including production overhead. It may encompass additional costs like distribution costs depending on circumstance. Alternative profit or loss format. Some entities use a different profit or loss format analyzing expenses by nature. This approach discloses costs like raw materials, consumables, labor, and other costs along with the net changes in inventories for the period.
In conclusion, our exploration of inventory and LKS2 highlights the crucial role in inventories play in businesses. LKS2 provide comprehensive guidance on accounting treatment, cost determination, and expenses recognition for inventories. It emphasizes the importance of disclosing relevant information in financial statements, ensuring transparency in inventory valuation method, carrying amounts, and changes. Understanding these principles is important for entities adhering to Sri Lanka financial reporting standards and contributes to prudent financial practices in managing inventories.